Understanding mutual funds, an in-depth exploration. Mutual funds have become a cornerstone of investment strategy for many individuals, particularly in the United States, where they hold significant portions of retirement savings. This article aims to provide a comprehensive understanding of what mutual funds are, how they operate, their advantages and disadvantages, types, and important considerations for investors. What are mutual funds? Mutual funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. This pooling allows individual investors to access a larger, professionally managed investment portfolio, which they might not be able to achieve independently. The management is often conducted by skilled professionals who analyze market trends and make decisions about when and where to invest the fund's assets, as outlined in the fund's prospectus. Key takeaways. Pooled investment. Mutual funds involve a collective investment from several investors, which minimizes risk through diversification. Prospective management. These funds are managed by experienced professionals, allowing investors to benefit from their expertise. Investment goals. Each mutual fund has specific investment objectives and strategies, such as capital growth, income generation, or preservation of capital. Fees structure. Most mutual funds charge fees that can reduce overall returns, so understanding these costs is essential for investors. The popularity of mutual funds. Mutual funds have become increasingly popular among American households. In 1980, only about 6% of U.S. households invested in mutual funds, whereas by 2023, that figure had grown to approximately 52%. The funds hold a significant majority, 88%, of mutual fund assets, reflecting their adoption for retirement and other long-term investments. Retirement investment. Many working Americans utilize mutual funds as a form of automatic investing through employer-sponsored retirement plans, such as 401k plans, which facilitate consistent investment withdrawals from paychecks. How mutual funds work. Earnings calculation. Investors earn returns from mutual funds in three primary ways. 1. Dividend/interest income. Mutual funds pay dividends from stocks and interest from bonds held in their portfolios. 2. Capital gains distribution. If the fund sells assets that have increased in value, those gains are passed on to investors. 3. Appreciation in share price. When the mutual fund's value increases, investors can sell their shares for a profit. The total return figure is a crucial metric to understand, as it reflects the net change in value over time, incorporating interest, dividends, and capital gains. Types of mutual funds. There are several types of mutual funds, with the major categories including 1. Stock funds. These invest primarily in equities. Subcategories include growth, value, and blend funds, which focus on companies of different sizes and characteristics. 2. Bond funds, focus on fixed-income securities to provide investors with steady income, typically less risky than stock funds. 3. Index funds, designed to replicate the performance of a specific index, making them generally more cost-effective due to lower management fees. 4. Balanced funds, invest in a mix of stocks and bonds, targeting risk reduction through diversification. 5. Money market funds, composed of short-term, low-risk debt instruments, they offer stability but often lower returns. 6. International and regional funds, invest outside of the investor's home country or focus on a specific geographic region, with varying levels of volatility and risk. 7. Sector and thematic funds, focus on specific sectors of the economy or thematic investment strategies, such as technology or sustainable investing. Understanding mutual fund fees. Investing in mutual funds often comes with various fees that can affect your overall returns. Expense ratios, cover operating costs, management fees, and can significantly impact returns over time. Sales loads. Some mutual funds may charge fees when investors buy or sell shares. No-load funds do not charge these commissions. Redemption fees, a fee charged for selling shares too early, usually implemented to discourage short-term trading. Other fees, extra fees might be charged for maintaining an account or performing transactions. Investing in mutual funds, how to get started. To invest in mutual funds, individuals should follow these steps. 1. Assess your financial goals, determine your risk tolerance and investment horizon. 2. Choose the right broker, ensure your brokerage account allows for mutual fund investments. 3. Research funds, use available platforms to screen based on criteria like fees, past performance, and investment strategy. 4. Start investing, decide if you want to invest a lump sum or set up automatic contributions. 5. Monitor and adjust, regularly review your investments and make adjustments as necessary. Mutual fund pricing mechanism. Mutual fund shares are priced based on the net asset value, NAV, which is calculated at the end of each trading day. The NAV is derived from the total value of the fund's holdings divided by the number of shares outstanding. Unlike stocks, mutual fund shares do not fluctuate in value throughout the day. Pros and cons of mutual fund investing. Advantages. 1. Diversification, reduces risk through varied investments. 2. Liquidity, shares can be easily bought and sold. 3. Professional management, beneficial for investors who lack the time or expertise to manage portfolios themselves. 4. Transparency, required disclosures provide insights into fund operations. Disadvantages. 1. Fees and expenses, high fees can erode profits over time. 2. Lack of FDIC coverage, unlike bank deposits, mutual fund investments are not insured. 3. Cash drag, funds must keep a portion in cash for liquidity, potentially reducing overall returns. 4. Diversification, overdiversification can dilute potential returns. 5. End-of-day trading only, investors cannot trade shares throughout the trading day as with stocks or ETFs. Conclusion. Mutual funds are an essential component of many individual investment strategies. They provide a versatile avenue for investors seeking diversified, professionally managed investment opportunities. However, potential investors should be aware of the associated fees, categories of funds, and investment strategies to make informed decisions tailored to their financial goals. As with any financial investment, understanding the full implications of mutual fund investing can lead to better outcomes for long-term wealth creation.